Hey everyone, welcome back to Corporate Decoder, the place where we uncork the secrets buried in corporate filings. Today, we're diving into Thrive Series Trust's latest filing, a peek behind the curtain of their Prospera Income ETF. Get ready, because this one's got more layers than a financial onion, and we're going to peel them back for you. And remember, if you love getting these unfiltered insights, hit that subscribe button and join our Discord community, link in the description. Alright, let's get started. We're re-looking at a document filed on the 23rd of September 2025, and it is essentially the birth certificate for a new fund, the Prospera Income ETF, ticker THRV, looking to list on NASDAQ. This is a prospectus, essentially an invitation to invest in this new fund. Here in the fund summary, we get the core mission, income and capital preservation. Sounds like a safe bet, right? But read on, because like any investment, there are fees and risks involved. Check this out. The management fee is 1.20%. That might not sound like much, but for a fund managing a lot of money, it adds up. And there are acquired fund fees and expenses of 0.60%. This means they're reinvesting in other funds, and those funds have their own fees, creating a bit of a fee-on-fee situation. They give us an example: invest $10,000, and after 3 years, assuming a 5% annual return, your cost would be around $566. That is essentially the cost of doing business with this fund. Now, how do they plan to make money and preserve capital? They're an actively managed ETF, meaning smart people are picking the investments. They're focusing on closed-end funds, American depository receipts, stocks, and bonds. They'll also invest in other ETFs and funds. They aim for income from interest and dividends and capital gains through short-term trading. They are also looking to exploit pricing inefficiencies, which is a fancy way of saying they'll try to buy things when they're cheap and sell them when they're not. This is where things get interesting. They're investing in closed-end funds, or CFS. CFs can trade at a discount or a premium to their actual value. So imagine buying a house for less than it is worth, but you don't know if that discount will last. That is kind of like CF risk. They can also have anti-takeover provisions, which might make it harder for shareholders to sell their shares at a good price. Then there is secondary market trading risk. This means that sometimes the price you can buy or sell shares on the exchange might be quite different from the fund's actual value. If things get crazy in the market, you might have trouble selling your shares, or you might have to sell them at a big loss. And get this, unlike most ETFs, this one plans to use cash for creating and redeeming shares, not just swapping other investments. This can be less tax efficient for you, the investor, and could lead to wider price swings between what you pay and what it is actually worth. There is also a significant mention of a large shareholder. This means one person or entity holds a big chunk of the fund's shares. If they decide to sell a lot of their shares, it could mess with the fund's performance and liquidity. It's like if one big customer leaves a small business. This fund is non-diversified. That means it can put a large portion of its money into a single company's stock. If that company does badly, the whole fund is impacted much more. It is like putting all your eggs in one basket, and that basket is a bit shaky. This entire document is basically a big, detailed explanation of what you're getting into. It covers everything from investment strategies to the nitty-gritty of how shares are created and redeemed. Their investment objective, provide income and capital preservation, is stated clearly, but it is also a non-fundamental policy, meaning they can change it without your direct approval, just with a heads up. As you can see from the table of contents, they get into the nitty-gritty of portfolio holdings, fund management, shareholder information, and even legal stuff like the declaration of trust. Remember that 1.20% management fee. It is structured so that as the fund grows, the fee percentage potentially goes down. So the more money they manage, the less they charge as a percentage. That is a common incentive for investment managers. The principal risk section is where they really lay out the potential downsides. You've got risks like credit risk, which is the chance that companies you invest in won't pay back their debts. Interest rate risk is about how changes in interest rates can make your bond investments go down in value. Market risk is the big one, basically saying the whole market can go down, affecting your investment. And there is new fund risk. This is a big deal. New funds don't have a long track record, so it is hard to know exactly how they'll perform over time. They also might not attract enough money to operate efficiently. Now, Let's look at the actual financials. As of the 5th of September 2025, they have assets of $100,000, all in cash with no liabilities. This is super early days, basically seed money. The net asset value per S-share is $25. This is the calculated value of one share of the fund based on its underlying assets, which at this very early stage is just the cash. The auditors, Grant Thornton LLP, have given their stamp of approval, stating the financial statements present fairly. However, they also mentioned that the fund is not required to have an audit of its internal control over financial reporting. This is standard for new funds, but something to keep in mind as they grow. They also have a policy on how they vote proxies. Essentially, they aim to vote in a way that benefits the shareholders and increases the value of the investments. But they do have a process for dealing with conflicts of interest, which is pretty standard in the industry. If their interests or those of their affiliates clash with the fund's interests, they have procedures to handle it, which often involves casting a vote based on a preset guideline or abstaining if a conflict is too significant. So what is the story here? Thrive Series Trust is launching the Prospera Income ETF, a new player in the market. They're aiming for income and capital preservation, which sounds appealing, but they're investing in complex areas like closed-end funds, which carry their own set of risks, including trading at discounts or premiums to their actual value. The fund is non-diversified, meaning it can concentrate its investments, amplifying both potential gains and losses. The early financials show a very nascent stage, with minimal assets, so performance is yet to be determined. The fees, while described as going down with scale, are present from day one, and the strategy involves a focus on active management and exploiting market inefficiencies. There is also a significant mention of large shareholders, which could impact liquidity and create concentration risks. Ultimately, this ETF is entering a crowded market. Its active management strategy and focus on closed-end funds suggest a proactive approach to generating income and potentially capital appreciation. However, the associated risks, especially around the non-diversified nature and the complexities of CFs, mean investors should do their homework. It is not a simple set it and forget it investment. The key will be how effectively the management team navigates these risks and delivers on its promise of income and capital preservation. Alright, that is our breakdown of Thrive Series Trust's Prospera Income ETF filing. What is your take on these numbers and what they signal for the company's future? Do you think this new ETF has what it takes to succeed in a competitive landscape? Drop your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out. And don't forget to subscribe for more deep dives into corporate financial documents. Also, join our Discord community, the link is in the description to keep the conversation going. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.